Hi, today we are going to take a look at Alphabet stock, also known as Google, and whether it's still a buy after the recent 20% rally it had. So you are probably familiar with Google, you likely use their services today. They own a lot of services including Google Search, YouTube, Android, Chrome, among many others. Most of their services are free to use, and they use these services to either serve ads or track users better so they can serve better personalized ads. So as expected, most of their revenue is coming from some kind of ads, about 2/3 of them, while they also have some other paid content and hardware as well, like Chromebook and Android Pixel. They also have the Google Cloud, which is the third largest cloud provider, and it is still growing nicely, so you can see on this chart. And I expect this trend to continue in the future as more and more users will need cloud services. They also have these moonshot projects which don't make money right now but could be big later on. So they have, for example, this Waymo, which is a self-driving car, and energy storage equipment. They also have quantum computing. So all of these moonshot projects could later on turn out to be very important business segment later on. They also heavily reinvest themselves by acquisitions, so they are buying up both potential competition as well as additional business opportunities. So they bought up hundreds and hundreds of companies over time, which is good, well, as long as they can buy them up in a good price, because it will really help solidify their position and continue to increase their revenue. So let's look at the long-term stock fundamentals for this company. As you can see, it has been nicely compounding over time, as well as the net income. However, I think it's important to point out that there has been this unnatural move here thanks to the stimulus money. So when we calculate its fair price, we may want to ignore this huge increase and take these as the normal growth rate. Similarly for the EPS, it also has this very high growth period. It's also nice to see that its PE ratio is now the lowest level since 2014. Google is also a very financially stable company with an Altman Z-score of 10, so they can easily pay their interest, about 280 times interest coverage. Also nice to see that they are compounding their assets quite fast, faster than their liabilities. Return on invested capital, very important metric, is in the long term about 20-25%. Right now it's a little bit higher, but again this is the period of the stimulus money, so I would ignore this and use this period as the long-term return on invested capital here. One thing I don't like here is the stock-based compensation is seemingly skyrocketing without any limit. So right now they provide about $18 billion per year of stock-based compensation, which is about 27% of their net income and 1.4% of their market cap. This means that just to keep the share count the same, they will have to do a 1.4% buyback, which is less than ideal. I prefer when the stock-based compensation per market cap is less than 1%. So getting to the growth here, they have a very nice track record here. They seem to grow about 20% per year. If we check every 10-year interval, again we see this 20%. Checking a lower interval, it seems like they sometimes go down to about 15%, but that seems to be the bottom here. They are also started to buying back shares, -2% per year, which is great for the shareholders. Apple stock also skyrocketed after they have started to buy back shares. Next up, let's use a DCF calculator to find a fair value for this company. The way this works is you have to fill out this form using these charts. and the program will do a discounted cash flow model. So first up we have to fill out the margin. So coming here we can see that right now the program has put in by default a higher margin than it has been in the past. So I would prefer to use this 21 to 22% margin. So let me put 21 here, but actually for this next year, because there is a lot of talk about a possible recession, let's use a little bit lower value, like let's say 19. So Google doesn't actually grow, and in fact the EPS is decreasing a little bit for 2024. Next up, growth. So we can use this revenue growth chart here. We can see that the growth has been about 16 to 20%. So let me use 16 here, and I will use the end growth 10%, because as the company grows it will be harder and harder to continue to grow. Next up, share count change. So there is negative 1.3% written here, which is using this already existing downtrend. However, for the end share change, I want this to change this to 0, because they have a lot of share based compensation, so they need to do more and more buyback just to keep the share count constant. And multiple, so despite the 10% growth here, I will want to use something a little bit higher, like 15, because it's a very important company. They have lots of monopolies, so it deserves a higher multiple. Now if these assumptions turn out to be correct, then the fair value is about $150, which is above the current stock price. And in fact the current stock price justifies a 15% annualized growth for the next 10 years. If the growth is lower than we expect, let's say just 12%, and in the end period just 7%, then roughly a 10% return is expected. However, I prefer my previous estimate about 16 and 10% growth for the next 10 years, because I believe Google will continue the acquisitions which they have. They will continue to reinvest themselves, and they will continue to be able to monetize services which are not yet so well monetized. So with the $151 fair value, we have a fair bit of margin of safety, about 44%. Of course, if you have lower growth estimates, then your margin of safety will be lower. Unfortunately, the price have recently skyrocketed despite the earning miss to $104 from the 86. However, I will still continue to buy shares despite the fact that the higher stock price mean lower long-term returns. However, as with every investment, there are risks. So the main revenue source for Google is advertising, but their share of advertising revenue is actually decreasing, taken by other companies like Meta here, but also Amazon, and recently also TikTok, which surpassed Google as the most visited domain. Google is also continuously facing lawsuits which take some of their net income occasionally when they succeed. Also there are government regulations which Google have to take into account, as well as some countries have already banned or planning to ban Google services. Overall, despite the risk, I think Google is a great company with a great future. I think they will be able to capitalize on the growing middle class from poorer countries and people escaping poverty. I plan to buy more stocks for this company, probably until $120. Thank you for watching, and bye.